Welcome, everyone. I'm excited to welcome you to today's Invest Blue Angel 101 webinar. I am Rachel Smalls, Program Director of Invest Blue, and I have the great pleasure of getting things kicked off here and welcoming all guests from all corners of the world, including the folks that we have here both live as well as folks who will be listening back afterwards. I know our network of Invest Blue encompasses, some founders, fellow venture colleagues of ours, as well as friends of Invest Blue and UK Innovate and the like. And so I like to take the time to just first welcome everyone and to congratulate you because you are now a part of the Invest Blue family. Here at Invest Blue, we're really excited to kick off this series, which is a special session designed to demystify the world of early stage investing. And so whether you're exploring angel investing for the first time, or if you're looking to sharpen your investing instincts, this session today will equip you with the actionable insights and the real world wisdom to do so. And really excited for the auspicious guest that we have today, who's going to break it down, no holds bar, straight no chaser, bringing his experience to the forefront and to tell you about it. Um, so before we get dived in and before I introduce our guest for today, just wanted to give a little bit of info about Invest Blue and the program that we have here. So Invest Blue is an angel network that connects the global community of Kentucky affiliated innovators and investors. Our key mission is to facilitate investments, offer educational support, and remove the complexities associated with early stage investing. For us, it's really important that we try to make the complicated simple when it comes to early stage investing and be that first place, that first gateway for anyone who is looking to learn about early stage investing or has ever been, considered of wanting to make that transition into becoming an angel investor. We're your place. We're your first stop to try to get the early learnings around that. And we bring experts and folks with the experience points to help give that education along the way. As you can see in the diagram here on the right too, it's pretty simple of how we go about facilitating these investments, offering educational support, and removing the complexities. We try to be the white glove offering for finding deal opportunities and pulling funds together amongst our members to facilitate those investments. And so we're really excited about the opportunity set to bring this kind of new opportunity and model to our great Commonwealth here in Kentucky. And most importantly, our job is to, really be, kind of the catalyst, if you will, for incredible talent that's all over the globe that does have a Kentucky tie, and to kind of make that bridge and connection point to the capital and the folks who have an affinity to invest in those same companies, come alongside those teams, give them the value and the support that they need to really scale, to accelerate their growth and be successful. So that's what we see our role here at Invest Blue. And today is just that, being able to bring an incredible expert to the region today to share. So a little bit about Jed before we get cracking here. Jed is the founder of AngelSchool.vc. It's a global angel investing platform that has trained over 300 angels across 40 countries. Jed is a self-taught investor and leads a thriving syndicate and boasts a portfolio that includes 2 unicorns and 1 exit, all without a traditional finance background. Prior to becoming the super angel that he is today, Jed built the world's largest API marketplace at an A16-backed startup. And his story is one of curiosity, courage, and clarity. And he's here today to share how you can begin your own investing journey as well. Jed's story is near and endear to my heart, coming from another, fellow kind of angel that has a non-atypical finance background. But more importantly, Jed truly has a heart for, not only backing the best founders, but really coming alongside and supporting those founders. And he has the same shared passion of democratizing angel investing and does that at a scale that I have never seen. And so really excited for Jed to bring his knowledge and learning to today's session. And so I'll stop yapping and turn over the baton to you, Jed. And from there, we'll try to keep, if you have questions, committed for the end of the session when Jed gets done. We'll do a quick Q&A. And so if you do have questions, feel free to, drop those in the chat and or reserve those for when he finishes up, if that's all right with everyone. So Jed, it is your show. Take it away. We're excited to hear from you, man.
Wonderful, Rachel. Thank you. First of all, let me put this up on screen and let's get set up. And whoever wrote that intro, that was like fantastic. Nobody's ever introduced me like that. So thank you for the kindness. Can you all hear me, see me, and see the screen? Great. Before we jump in, I'm going to put a couple of links in chat in case you all want to connect on LinkedIn. And I'm also going to give away a completely free community resource available to all of you. Okay, so there it is. Now, nice to see all of you. Welcome from Singapore. It's 6 a.m. Here in Singapore, and I love this so much that I'm happy to do this 12 hours apart from all of you. Today's session, I'm calling Angel Investing Pro Tips. Somebody who is a self-taught angel investor, never have had professional VC training, and at this point in my career, I back 2 unicorns, as Rachel said. We're very excited to do this webinar with the Invest Blue community. I'll go through the intro very quickly just because Rachel's done an amazing job already. Formerly as a tech operator, I built the world's largest API marketplace with an A16Z-backed startup. As a venture investor, somebody who's self-taught, never worked in finance nor VC, I've done seed to unicorn investments twice. I accidentally became a super angel by starting to build my angel syndicate in 2021 during the pandemic. Today, my investor network is backed by 1,400 investors. I believe we're cresting 1,500 any day now. Angel School, I describe as an angel accelerator. We work with investors all the way from their first check or people who are even just venture curious to leading syndicates as super angels. So that's the story. Before we jump in, let's articulate and understand this concept of a syndicate, because people understand what angel investing is. They sort of understand what a VC fund, and then there's this weird orphan child in the middle called the syndicate. And so what is this, and articulate why I'm so hard on this. You can think of a syndicate as a market maker, and we sit between 2 sets of stakeholders. We've got investors or LPs on one side and startups on the other. For my investors or our investors, what we serve them with is curated deal flow. We do sourcing at scale, full diligence and data rooms for our investors. And the value proposition for our investors is you build your own portfolio. Outside of that, 0 commitment to invest. And on the startups that we serve, we are providing capital access. Now, if you think about it, a syndicate should comfortably be writing 6-figure checks. We've written as large as 7-figure checks. And it sits kind of nicely in the middle between the 4-5-figure angel check and the 6-7-figure VC check. There's got to be a space for this, right? The syndicate vehicle is perfectly placed for this. Now, founders often say, hey, why work with a syndicate? It's one clean line on the cap table. And while that is true, think about what actually enables that. We have spent months and years pre-building all of these relationships to give access to the founders. That's the real power. This is the secret unlock for capital. Okay, and I think this investor community used well also becomes an access to an expert global network. Okay, so this is the concept of a syndicate, why they exist, and what the value proposition is for both the investors and the founders. Okay, so let's start with some basics. Let's think about evaluating your options. If you're completely new to this, 101, how should you think about your paths? Okay, effectively, there are 3 paths you can go down the venture route. You can be an angel investor doing direct deals. You can be part of a syndicate, could be mine, could be Invest Blue, could be any number of others out there. Or thirdly, you can be an investor or an LP, a limited partner in a VC fund. Okay, so we're investors, so we need to understand economics. Let's start out with return patterns. So imagine you're an angel investor, and I'm going to pick David because he was the first one in the session today. Welcome, David. Thanks for joining us. Imagine you're an angel investor and you invest in a series of companies, these 10 here. All of these bars represent one company. The whole point of venture is that every company that you invest in has a theoretically high or multiples or uncapped upside, but you also are exposed to a max loss of 1x. So the worst case scenario is you lose all your money on any individual one of these companies. Now, let's say let's assume that David's portfolio does this. You've got the companies in green that return a profit, the ones in red that go to zero or don't return very much at all. Your portfolio return is just the summation of everything, right? So this is your portfolio 1x return line. And let's assume that here, David's done okay. The companies that return a profit in green outweigh the ones in red. Anything above 1x is just profit for you. So there's nothing magical about this. Now, let's say somebody else, I don't know, Jeffrey, is an investor in a syndicate. Right? And so the economics of being an LP or an investor in a syndicate looks like this. I'm going to share 6 companies, A through F, with Jeffrey. On the average deal, I'd say that expect about 5 to 7% of your capital commitment going towards fees. Okay, so let's just use 5% as an example for simplicity. Let's say on an average deal, it's 5% going towards admin costs. This will cover the SPV, the deal structuring, and some management fee in cash, which the syndicate takes off the table to help cover costs. Which means that on every deal that you do, 5% gets shaved off the top, 95% gets deployed. And in this case, Jeffrey decides to invest in companies B, and E. So those 3 companies. And of course, his returns are going to be restricted to those 3 companies. Now, even though 95% of your capital is deployed, we're only calculating returns above 1x. Okay, so whatever gets shaved off needs to be recovered first before any carried interest applies. And in this case, it turns out Jeffrey's done pretty well. 2 out of 3 companies he decided to take a swing at return above 1x. So company B and E return a profit. Company D was a bit of a dog, right? And so the returns to Jeffrey look like this. For the companies that return above 1x, okay, Jeffrey is entitled to 1x liquidation preference. He gets original capital back up to he's made 100% whole on those deals. After that, there's something called carried interest. Think of that as just profit share, which typically in the industry is 20%. So on companies B and E, Jeffrey's going to get his original capital back, and then anything above that, he gets 80 cents on the dollar. And then the bars at the top here, this 20% is shaved off for the syndicate who retains that. Okay, so this is the economic model of a syndicate. And finally, we've got a VC fund. And let's say that Matt has invested in a VC fund. VC funds, you might hear in the industry something called a 2 and 20 model. What 2 and 20 refers to as 2% management fee a year and 20% carried interest. Okay, so the average fund life is 10 years. So 2% a year times 10 years is actually 20%. So actually, really, you should call it 20 and 20, but it doesn't sound as nice. It sounds kind of expensive. I think this is why VCs say 2 and 20. But this is what this bar here on the left is meant to represent. So if Matt decides to invest into a VC fund, 20% of his capital ends up going towards management fees. This covers administration costs, operations, salaries, and only 80% is deployed. And out of this, the fund manager or general partner, GP, decides what to invest in. And so the fund decides to invest in all of these portfolio companies. And they perform like this, and the entire portfolio does this. So note again that even though 80% of the capital gets deployed, we're only calculating portfolio returns above 1x. Okay, so here we have a profit. And again, the fund does return something above 1x, which is the green bar. The returns waterfall to investors look like this. You're going to get original capital back up to 100%. Above that, funds often, I'd say 70% of funds have something called the return hurdle. This is, think of a return hurdle as cost of capital, right? It's like taking a loan from you, and usually that's 7-8% a year. So based on the time that the capital is outstanding, this loan accrues interest. And so it's got to return, Matt, that 7 to 8% a year. That's what this bar represents. Above that, Matt is going to get 80 cents on the dollar because there's 20% carried interest, and the fund retains 20%. Okay, so this is the concept, the economics of how a fund operates. So if you're looking to compare qualitatively across these different areas, here's a detailed breakdown. We don't really have time to go through all of this. And by the way, all of this content is going to be available in that masterclass resource I shared, but I'm going to give you all the takeaway. Okay. The first one, I would say that these three are discrete options. It's not mutually exclusive. You don't have to choose, right? You have to pick your own philosophy, your own approach based on your own philosophy, what's important for you. I'd say that in general, a VC fund is a big ticket blind pool vehicle, right? On the very low end, it might be a $250,000 check minimum, which disqualifies 99% of angels. And I think it also removes you from this process, right? So there's less of an active effort. You're not learning from this, which is like one of my biggest issues with this. I actually believe that I can be as good or better than a VC. So I want to get my hands dirty, and I'm okay with that. So a VC fund, it's a passive choice. It's a blind ticket vehicle, right? So that's why you would do that fund. If you believe in the fund manager, if you believe in the thesis, you're okay with the economics, and you want a passive vehicle, this is the right approach for you. Which means that practically speaking, if the fund is not for you, then your main choices are being an angel or being part of a syndicate. And here I would say it's not an either or. You can have the best of both worlds. You don't actually have to choose. But with a syndicate, you get a few things. You get curation, access, and filtering benefits, right? Because the group is organized, they're doing more sourcing, it's more of an active effort. They are doing diligence for you. They should be. Not every syndicate operates like this. I'm a big believer in having a lot of diligence, right? It's just I'm representing deals to my investors, and I take that very seriously. In both cases, you get 100% decision control of what you want to invest in. So why would you give up that free option? There's time savings because Jed will stay up late doing diligence. He'll get up early and do webinars, right? Because I'm nerdy like that, and I'm okay with it. You get a better diversification benefit. For a given amount of capital, you potentially get to spread your capital into higher quality deals. What you have to trade off is fees and carried interest, which is sharing the upside. And you have to decide for you if this is the right mix. I'm not here to say what it is or isn't. You know, this is just, I'm laying it out so you understand the mechanics here. Okay. So let's kind of shift gears a little bit, and we're going to talk about some venture axioms. I'm going to encourage you all to be a little bit interactive here. I'd love to hear your thoughts on this. Okay, these are just common things that are said in venture, and how I'm just going to challenge the conventional thinking a little bit, right? And say, like, do we agree or not? Okay, so that's the question here. Let's start with something really basic and simple. If you had to make a trade-off between team and idea, would you rather have a team with a pretty good idea and killer execution, Or would you rather over-index on idea? An amazing idea, but pretty good execution. Which one of you would pick, team versus idea?
Idea.
Okay, so Rachel says in chat, and Jeffrey also team. David's arguing the counterpoint idea. David, thoughts? Tell us why. Be the contrarian in the room.
You know, with enough time and resources to experiment, an amazing idea can work out and run forever. When a good idea can be usurped by an amazing idea.
Yeah. Okay, so David is making the same point, kind of like Victoria, a good idea could sell itself. I don't agree, I don't disagree with this, by the way, right? I think, but ultimately this is philosophical. My view is that I would pick team over idea. And my premise is that ideas in and of themselves, yes, they could sell, but they don't have intrinsic value in and of themselves, but it does rely on the team to go execute, to generate value. And Jason's also making the point to pivot. And so for that reason, I would pick team over idea. Okay. So let's ask a more challenging question. If we pick team over ideas, let's say you agree with my premise, would you pick team? Would you trade off team or market size? So imagine the world of startups fits on this quadrant, this 2x2. Horizontal axis is market size. You have small markets on the left, ginormous markets on the right. The vertical axis is team performance, if you could somehow qualify that. You have a crappy team on the bottom and rock stars on top. We only care what's in the top right quadrant, right? Everything else is a throwaway. Looking here, would you pick a rock star team in a small, in a good size market? We don't care about a small market, right? It's a good size market, or would you rather pick a pretty good team in an absolutely ginormous market? Any thoughts?
Give me a ginormous market, and I can overcome a poor team, or I can develop a weak team.
Okay, so we've got 2 points, right? Jason in chat is arguing that he would focus on the team because the team can work into any market. David is arguing the counterpoint on that. And so I'll lay out what I think. I would actually personally pick market size over team. Okay. The reason is that this, for me, actually looks like this. Okay, what I mean by that is that if you think about the delta between market size and team performance, this is what the scales really look like. Okay, think about $1 billion market and $1 trillion market. We're talking about 1,000x difference, and that's order of magnitude stuff. If you think about team performance between a pretty good team and a rockstar team, I don't have any data or research to back this up. But what is the delta? Is it 10x, 20x, 50x? It's very hard to argue that good and great team performance scales more than some number like that. But market size absolutely legitimately do. So for that reason, I would favor market size and trade that off against team performance. Okay. Something else. This is commonly said in the venture industry, and I kind of disagree with it a little bit. People say, is it about quality deal flow is all that matters? Have you heard that?
Yes.
And so the question is quality deal flow really the crux of this, or is diligence and making decisions great more important? If you ask me, I would pick diligence over deal flow. Why? It's for reasons that aren't necessarily intuitive. investors, I think a lot of investors, right, and I'm not just singling out angels, even professional investment professionals, there is no common definition for diligence. I've seen diligence that frankly, it's shockingly shoddy for me. I do also think that a lot of investors overvalue signaling, right? Often when we say somebody's got great deal flow, they're referring to signaling value. They're saying things like, hey, it's a pedigree founder, he's got VC backing, something of that nature that is indicative of future success. It could be, but I don't think, and those things are valuable, they are data points, but they aren't the full package. For me, in my experience, having seen enough deals, it's the overall package that comes into play, right? You got to look across, and diligence is the skill that matters there, because if you're not looking across these things and focus on single data points, you end up missing a lot of things that could derail the deal, right? The simple thing like, hey, what's on this company's cap table? What does that look like, right? That single thing can just destroy a deal for me. So this is why I pick diligence over deal flow. Next, defensibility. When you start meeting founders, you meet startups, you start asking this question, what's your moat? What's your competitive advantage? And very often I've noticed investors want to hear these things. They will say, I want to hear about your patent, you have some proprietary data, some technologies, your flywheels and network effects. In my view, I think reality looks more like this. And this is conceptual, by the way. There is no numbers behind this, right? The point I'm trying to make is that companies or investors underestimate the practical matters, right? Things like distribution and sales and go-to-market at the very earliest stages. Things like data, technology, flywheels, they don't exist because these are a function of scale. But it takes some time to get there. So by definition, when you start out, they don't exist. Patents, sure, you could file a patent, but there's plenty of filings at the USPTO that will never get $1 of commercial value. So who cares? And you know what? If your patent is really that compelling, as a generalizable rule, of course, right? There are exceptions. If it's really that valuable, somebody could infringe, a large company could infringe on it, and they could tie you up and drown you up in lawyers. Right? So it's a very practical matter. My point here is around distribution and why that matters, especially at the very earliest stages. I would point you to this article, right? This article is called Where to Go After Product Market Fit. It's an article by Elad Gil, who was Twitter's first engineering VP, who interviews Marc Andreessen from A16Z. And he makes the argument back in the day where Andreessen Horowitz was classically a software investor. And he says that in a software world, what matters is go-to-market and distribution and your business model around that. Trying to compete on product and features is an arms race. It's a race to the cliff. It basically means having to launch killer feature after killer feature. And it's very, very hard to sustain advantage that way. But being advantage and being able to take advantage of that, being ahead and being able to take advantage of that commercially is what matters. That is a more sustainable moat. Okay, one more. Power law. VC is a game of power law. If you haven't heard this before, power law refers to, effectively, is the 80-20 rule. We're saying here that in any given portfolio, very few companies will return a very large multiple return on the left, and then you're going to have a very long tail that's going to return very little or outright go to zero. I think that power law, when it describes a statistical mathematical principle, is absolutely correct. But my argument against power law is that venture distorts what they say when they mean power law, right? With venture, commonly when people say power law, they're not referring to a statistical principle. They're making the argument for diversification. they're effectively saying, because this exists, you should invest in 50, 100, 200 companies to increase the odds that you're going to hit that outlier return. Okay, so there's a distinction there, right? This is a bit of a nuance point. And so power law is different for angel investors, for all of you here. One is that, as in life, think about people's incentives, especially economic incentives. VC business model rewards fund managers on the upside. So the more bets that they make, power law equals diversification, the more they increase the odds of finding that one company that returns the 100x. Second, there is a trade-off in making diversification. When funds, VCs make the argument for diversification, they're saying, okay, I want to invest in 10x more companies because that increases my chance of hitting that outlier return. In order to scale that and keep everything constant, you need to be scaling your deal flow 10x, your bandwidth 10x, your expertise and decision quality 10x. Otherwise, you are making a trade-off, and those things get forced very, very quickly. And thirdly, there's leverage. In a VC fund, there is something called a GP commit, which is typically 1 to 2% of the fund. This is their skin in the game, which means that 90 to 99% of the fund comes from investors. Put another way, VCs get to lever up on capital 50 to 99 times on investor capital, and then they capture upside from it. You as an angel investor, you have the zero leverage, which means that failure costs, when you make a deal that doesn't work out, you absorb that 100%. Okay, so this is like my argument against classical power law as it applies to venture. Which brings me to my first takeaway. Conventional wisdom in venture comes from the VC perspective. Nothing wrong with that. I'm just like calling it like it is. The risk-reward calculus for you as an individual investor is inherently different. So internalize that math well. Next, I want to talk about something more topical. Okay, this is, I'm going to address something called the funding winter of 2021, which is a period that's still ongoing today, right? Maybe we might be through this in a year or so and things are going to be on the upswing, but this is the state of play today. What this data here shows is quarter-on-quarter valuation changes for different stages of companies, right? This is a US average and might skew a little bit towards the coastal cities, but this is a pretty good broad average. So we're looking across the rows at every single stage, quarter-on-quarter for the last 4 years, how valuations, median valuations have changed. If you can see here, we see a string of red boxes if we go left to right, and this indicates the start of the funding winter in the second half of 2021 onwards. We saw signs of stabilization in 2023 in the first half, and we're seeing some green shoots of recovery. I'd say we're not quite at the bottom. We're still pretty low, but later stage companies, pretty rocky recovery, right? Pretty big upswings and downs. If you look at median valuations, we see something starkly different between what's happening at earlier stage and later stage. At seed and Series A, we saw 10 and 20% declines against the valuation peaks and a timestamp, let's say Q2 2023. Okay. When we looked at later stage companies, Series D and E, we actually saw 60 to 70% decline. So this mirrors the data we saw earlier, which is that later stage companies are correcting far, far more. Another view of this comes from secondary markets. Okay, secondary transaction or secondary market effectively is a transaction between a buyer and seller of a company outside of a normal funding round. So let's say here that Eric has bought into a company at Series C, and 12 or 18 months later, he wants to get out of this, and he looks for another buyer, and maybe he approaches Jason, and Eric and Jason are making a deal outside of a funding round, right? They just saying, Eric says, I want out, Jason wants in, and they negotiate on the price. What does that look like? So this data here, we're just going to track the black line, which is the median deal, right? Let's just focus on the average. This data here is interesting because we can almost exactly overlay the two periods, right? On the left is when is the venture boom, when things are going well, and on the red, on the right half is the funding winter. What we tend to see is that during a bull market, the peak of the venture market, the median secondary deal was trading at par value or maybe a slight discount to the last funding round. Okay, we just eyeball this. That in itself isn't a great deal because this means if Eric had invested in, let's say, Series D, 12 or 18 months later, he's trying to exit on a median deal. If you picked average, he would have to get out and get his money back or maybe take a slight discount after 12 or 18 months. That's not great. But in the funding winter, we saw a massive pullback, right? As much as 50% discount to the last price round. And this is the number one indicator for me of tracking venture health. Today, the median deal is trading, median secondary deal is still trading at roughly 40% discount, right? So this is a good proxy indicator. Now, all of this is happening against this backdrop. Context is important. In the venture markets, we've basically seen roughly a 20-year run-up in capital deployments. In the US alone, we went from about $40 billion a year in 2011 to peaking at $345 billion a year in 2021. So that's 9x growth. So this pullback that we're seeing is against this context, which brings me to my second takeaway. This funding winter, this reset in valuations, it's a generational reset in capital availability and inflated valuations. If you're long in venture, only if you are long in this, if you're a believer in this, you can also contextualize and see this as the best time to start venture investing. Okay, for what we do, writing $250,000, $500,000 and up checks, we're getting into VC-led rounds, AI companies at Series A now. We can do it, taking allocation. This would have been impossible 4 years ago. Okay, so let's go to some venture math. I might have to skip some of these slides in the interest of time, but if Rachel, Eric, you all want me back, I'm very happy to do another session. We've got tons of content. So let's do some venture math to show some numbers. What we're representing here are venture benchmarks. Okay, so this is roughly in line for what the average company looks like across different stages in terms of valuation. The step-up multiple, which is the increase in valuation across rounds. We have median dilution here on the bottom. And the very last row is MOIC, mark on invested capital. Think of this as ROI. So this effectively says that if you go from pre-seed and the company is valued at $6 million, at seed round, you get a 2.2x step-up multiple in valuation. That brings us to 13. 21% of the company is sold, and that causes dilution, and that brings your ROI or your MOIC down to 1.74. That's how to read this. Okay, so these are just placeholder numbers to simulate this. We can also represent this data in terms of a table, right? And here we're looking at entry stages on the rows and exit stages on the columns. Okay, so for example here, if you invested at pre-seed and you were able to exit at seed stage and you got 100% of what you're owed, you would get 1.74x return. This is what the numbers represent. On the other hand, if you invested at seed and held, let's say, all the way to Series E, the numbers show that you'll get a 33x return. Okay, so the point here is to is to illustrate the concept of compounding. So even though the net return in between stages is 1.5 up to 2.5, 3x, by holding on to multiple stages, those returns, they're not additive, they're multiplicative. So there's a compounding effect, which is why from seed to Series E, on the average company, you get a 33x return. The question becomes, what does an average company look like? Right? What does average look like? How do we actually define that? And it turns out it's really, really difficult. If you look across all kinds of different areas, there's so much variability. Take the example of growth. This data comes from Bessemer Ventures, right? They're a cloud investor, and they mapped out performance on their portfolio across different tranches of revenue. 1 to 10 million ARR, that's the first bar. The second is 10 to 25, etc. And the blue bars, the dark blue bars, represent the span between top and bottom quartile performance. So let's look at 1 to 10 million ARR. That's roughly Series A. The data says that a company needs to be doing 230% ARR growth at this revenue range in order to be considered top quartile. And if you're doing 100% year over year, basically doubling year over year, you're actually bottom quartile. So it's a pretty big span in growth rates, right? We're talking between doubling year over year and tripling year and quadrupling year over year. The sectors that you play in also matters. Okay, here from the same study, if we look at valuation multiples across different sectors, you see a massive span. In that particular year, I think it was done in 2021, fintech was the most richly valued sector at 33x. If you're in a communication sector, it was 10x. So there's a 3x valuation difference across these sectors, which is just nuts. And we're seeing this trend will always play, right? You're seeing the same thing in AI today. Even something as innocuous and mundane as dilution. Earlier on, we looked at median dilution across the funding stages. But if you take a plus minus 10% span on median valuation, you see that there's actually a range of 70 to 90% of companies in plus minus 10% on median. That's a massive difference on something as boring as dilution. And so let's come back to this. If you look at this data, the numbers look a little bit different this time. And the reason they look a bit different is I'm simulating here what it looks like if you picked a company that does 10% better than average. Okay, I'm not talking about multiples. I'm saying 10%. The numbers say that if you pick a company that just does 10% from seed to Series A, your MOIC actually increases from 33x to 54x. So small differences in your picks actually make a very big difference to the returns. So takeaway number 3 is this. Venture is more than how many deals you do, right? That diversification argument. And let's be honest, it's also ego. People want to flex. I did this deal, right, about deploying capital rather than the numbers coming out. Turn variability to your advantage. So venture, really, I see it as a game of probabilities and math. Okay. I'm going to skip this section. I'm sorry, just because we do have a few more things. And this is like, I made it as a placeholder. I'm going to sort of end with this, and then I've got a few concluding messages. If you are starting out, you want to brush up on your principles. I call this my 7 deadly sins for angels. These are common mistakes that I hear and see investors when they're starting out make all the time. And I share this not to say it's bad or anything, just be aware of this, right? You don't have your blinders on, be aware of these things. If you're doing it, you might want to rethink it. And our 7 deadly sins look like this. Okay, so I'll talk through them very briefly. The first one is overpricing. The data for me is very clear. Early stage investors, especially angels, habitually overpay for startups. Part of it is this small check that you write. It makes you a price taker. So you're accepting pricing from whatever a founder is asking for. Okay, so I think this is a power of also being part of a syndicate, because you band together, you're negotiating terms a lot more. Generally speaking, unfortunately, angels are generally poorly informed. And so a lot of why I spend so much time sharing knowledge is because I want everyone out there to be like more well-informed, because this is how we have a sustainable, healthy ecosystem. Second, the too early to diligence argument, and I call massive BS on this. You can always diligence, no matter how early the company, a market size. You can look at a 10x value proposition over competitors. It's really simple, right? Look at a company and I need to be able to communicate, why is this 10x better? If it's not, if I can't, if I'm struggling to do it, then it's just not good enough. Founder market fit. This is the idea. Do the founders know the industry that they're working in? You can look at a company's funding history in a cap table. Is it clean? Or have they raised a bunch of convertible financings, and when all of these trigger, the founders are going to get diluted to a tricky position, which which increases the risk of a recap or jeopardizes future funding. Third, overvaluing signals. I alluded to this earlier. If you're investing because it was an XYZ founder, maybe the large startup failed, but we're willing to look past that. Is a FANG employee. Well, how much does Google employee 182,000 actually move the needle on their stock price? Probably not that much. Even something like VC backing. Okay, I'm not saying that these data points or signals have no value. I think put in the right context. I don't believe in pressure. Right? So FOMO, fear of missing out decisions. Don't respond to exploding deadlines. 90% of the time, it's arbitrary when I do deals with founders and they say there's a hard deadline on this date. I'm very happy to call BS and make them walk that back, because very often there is more time, right? Very few situations, there's really an exploding timeline. The massive market. I think investors also have a bad habit of just taking market sizing at face value. I always do my own. Ego, being told their value, your value add or strategic. I can be honest enough and say okay, my job is to be an investor. I don't think I can help every company in every facet whatsoever. Know your rights. At the very early stages, I would expect pro rata rights on all of our deals. I would expect commitments on investor updates on the founders. If they're not willing to do these things, it's a little bit of a warning sign for me. We talked about power law, especially when you're starting out. It's intuitive that your deal flow is going to be underdeveloped. If you are jumping in too quickly, you're over diversifying. You're investing too much, too quickly, too early. You need to diversify. Don't get me wrong, but you can do it over a period of many years. When you do these things, you are underpricing venture risk. And finally, skills development. It's a long game. Your skill building takes a long time, so start early. And also keep in mind capital preservation. Seeing many companies doing a lot of diligence reps doesn't cost you capital. And I'm a big believer in this, especially for angels. So let's conclude with this. Pro tips. Number one, if you're going to do venture, assume that whatever you invest will go to zero. Be prepared to walk away, right? Don't assume that you can cash your chips and walk out whole. Second, take your time. It doesn't feel like it when you're starting out, but deal flow is limitless. Capital is finite. So be stingy with writing checks. Keep your early euphoria in check. Third, think about your outcome levers. There are multiple ways to improve your odds of success. These are like weapons in your arsenal. You can do more deals, diversify. You can do bigger, more concentrated check in fewer deals. You can focus on doing better diligence. Number four, Diversify over time. Don't be a rush to write checks. You're in this for the long game. You can diversify over a period of many years. I've been doing this since 2016. My entire active portfolio today is between 20 to 25, so it's pretty concentrated. Number 5, play for life-changing outcomes. The whole point of venture is to get outsized returns. You want a 10, 20, 50, 100x your money. If you back a company that returns 100x, if you start out with $1,000 and you got to 100,000, it's still a little so what? It's nice, don't get me wrong, but it's not quite life-changing money. So on the other hand, going from 10K, 100x to a million, now we're talking. Number 6, invest in your skill. Diligent skill is a big success lever. It takes many reps and time to develop. Start working on this early. Great decision making is going to carry you in the long term. And join syndicates. Doesn't have to be mine, doesn't have to be InvestBlue. There are all kinds of others, right? I'm not trying to sell you on my deal flow or anything, right? I'm just saying, think about this. Let somebody else do the heavy lift of sourcing deals, doing diligence on your behalf. You have 100% decision control over your portfolio, just like being an angel. However, I will say not all syndicates have high standards, so you want to vet carefully. So in conclusion, let me bring this together with this message. What is our mission with Angel School? And parentheses, what I want to do is to solve venture's resource allocation problem. Okay, I'm going to make this argument to you. You might not agree. My argument is that venture has this, what I call a resource allocation problem. It is that all the resourcing, attention, and focus is asymmetrically directed towards founders and startups. There's nothing wrong with that, by the way. We have grants, programs, accelerators, mentorship, My argument is that when it comes to the capital side of the equation, it's a fixed sum game. We sort of tell founders, go find angels, go find VCs, and full stop. Right? If we sat down here and tried to do some napkin math and to say, how many investors out there, how much capital they could deploy, and just came up with a number we all kind of agreed on, I would argue that that number is 10, 20, or even 50 times smaller than it should be. Right? The reason is that, and the reason I spend all this time sharing knowledge and giving stuff away for free and getting up early is that we want to grow the capital side of the equation, because doing that brings balance. And this impact is how we're going to bring balance to the venture ecosystem. So while everybody is saying, let's go help founders and startups directly, I'm saying, let's go build up the capital side of the equation, because that needs far more work. With Angel School, I'm really proud of the impact that we've made. Okay, at this point, we've impacted around 300 investors in 40 different countries. I have no team, no marketing budget. It's completely organic and referral-based, and we're really proud of this community around the world. Along the way, we've helped create, scale up, and launch 20 syndicates in 14 countries as well. Okay, so put together, Angel School, what I operate is a super network. We have 3 different teams looking at deal flow from different regions. We have a US team, a Europe team, and one in Southeast Asia. This version of what we're building is really about having infrastructure. Okay, so this is the mission. This is why what we do, and we're really excited to be working and partnering with InvestBlue and communities around the world. Don't forget to grab this. I'll put the link in chat again in case you want it. But this free masterclass I'm giving away as venture for angel investors. It's a resource that I maintain. Please get access to that. Take advantage of it. And with that, we're just about at time. Thank you all for being here. I want to be respectful of your evenings.
Amazing, amazing, amazing. Jed, we cannot thank you enough for today. So I'm not gonna, I was gonna flip my screen over, but I wanna make sure everyone does get that link, because this is a really, really good resource. So first and foremost, full disclosure here, I am also a member and a student of Jed. Angel School is a really, really great resource. And like he mentioned, same thing in InvestBlue land, we are very much not beholden to our own. Obviously, we have a syndicate and program and opportunities for members to join. But yes, we're one of many, and Jed put it perfectly. We're all about the mission. We're aligned in this, and that the capital side of the equation, we really want to be a part of the solution and helping to increase people's venture acumen and really increase the knowledge, know-how, and network for angels all across. So all to say, please use these resources. You know, Jed, of course, is one of the masterful folks in the ecosystem that's doing this all around the world. We're of course joining the fold and doing this here in Kentucky as well too. And so what I'll do is, we did promise a Q&A. So instead of using the time for a Q&A on this call, I'm gonna have my team actually drop our email. Contact us at investblue.org. We could drop that in the chat. That way everyone can send your questions that you did have for Jed. Jed, if you're okay with that, we'll email that to you so that we can try to get some of those questions answered if possible. We'll also do this, Jed. You're welcome back anytime, my friend. We'd love to have you for a part 2, because this was so incredible and incredibly dense, but beyond that, masterfully done in terms of having people get to learn about angel investing and getting their first spark at it. So with that, what I'll do is, again, I'll have the folks, our team, put in the chat our contacts. You can also go to investblue.org, find out more about our group, our syndicate, and our academy that we have. Easy to kind of join with that. It's very much easy to join. Front doors, our application to all things. But more importantly, Jed, thank you so much, my friend, for your time today. Thank you so much for taking the time to give this masterclass today. And most importantly, we will look forward to sending you everyone's questions and to have you back, my friend, because it was very, very awesome.
Yeah, sign me up. I'm there. What do you want? Tomorrow, same time? I'm kidding.
Same bad time, same bad place. No, very much, man. We appreciate you. Thank you so much for getting up early, obviously, in your time zone. I was even filled with even more questions, even though I've been through some of your classes, because what you shared today was spot on in terms of what's happening in the venture market. And so yes, we will collect folks' questions, get those over to you. And it's for everyone who joined today. Thanks again for parsing the time on your evening tonight to join our team. We really are excited to bring more content and value and information to our ecosystem, but also to our members as well. So thank you for taking the time today. Consider this as your first entry into the InvestBlue family, and we'll have more to come in the future of bringing some really awesome talent to our ecosystem to share about angel investing. So thanks, everybody, and enjoy the rest of your evening.
Bye now.